welcome to the AMI podcast. I'm your host, Bud Evans. Joining us today is Mark Willis. He's a certified financial planner who brings a unique perspective to financial management. Today, Mark and I are diving into some of the engaging financial strategies that promise more security and sanity without the burden of unnecessary risk. So stay tuned as we explore alternative approaches to achieving financial freedom, where we provide real estate investors with the tools to achieve generational wealth. Let's aim high together. This is episode 83. Memorial Day is a time for reflection, pause, remembrance, and thanksgiving for patriots who gave up their lives to protect the lives and freedom of us all, including the freedom of generations long gone and generations yet to come. We owe the fallen a debt so enormous that it can never be repaid. Don't thank me for Memorial Day. Don't thank me for my service today. This is for the fallen. God bless you. God bless America. Hello and welcome to the AMI podcast. I'm your host, Bud Evans. Today I'm joined by Mark Willis. He's a certified financial planner, and we're going to go down a couple of rabbit holes. Mark, how are you today?
Oh man, doing great. Thanks for having me on.
Oh, it's an absolute pleasure. Listen, I get to sit here. I know I say this all the time. I get to sit here at my desk and just talk to really cool people who do really cool stuff. Can you do me a favor and just give me a quick introduction?
Sure, I have the great privilege of working with clients all over the country. We work with real estate investors, we work with business owners, and we even work with some NFL Super Bowl champions. But most people I work with just want more sanity, more security, more certainty that their plan that they're working toward and blood, sweat, and tears and money is going to pay off for them. And they don't want to reach those objectives without taking a bunch of unnecessary risk. I meet people all the time who expect that it's required of them to take just uncalculable and unnecessary risk just to reach retirement or financial freedom or whatever they've defined as their objective, kids' college. And it's patently false. You don't have to take a bunch of unnecessary risk. You can reach your goals and do it in a way that's sane and leaves you better off and your family better off as a result.
How did you wind up at a CFP? Was it like, hey, I just went to college and I thought it would be really cool? Or was it something else?
Oh, no, yeah, the complete opposite. I got a degree in something altogether different from finances and money. I went through undergrad and then graduate school and graduated from a seminary, actually. I never expected I'd get into ministry full time. I love the ministry. I think it's a great way to spend one's life, but I just never saw that as my calling to do that for work. So I had to find work somehow. And I jokingly say my favorite book of the Bible was the book of Numbers. So I got into finance a little bit, and I was working for a CPA firm part-time along with a bunch of other property management stuff and real estate to get my feet wet in that area because I saw the value of real estate and just because they had a job opening, man. Because I graduated in 2008 with a great time to be looking for work, by the way. And we had six figures of student loan debt that was knocking on our door. And so it was a really out of a necessity to have multiple jobs. And the CPA firm got me focused, interested on this thing called money. It also got me interested on this thing called taxes. That's interesting. And on this thing called debt, which I had plenty of. I had, as I mentioned, six figures, 120 grand of student loan debt and no plan to pay it off. So the CPA was making the phone calls to her clients. And unfortunately, this was 2008, 2009. She was making those calls, and you probably know what those calls are like, where she says,
Mhm.
"Hey, Mr. Client, I'm sorry. I know that you've been working on your IRA for the last 35 years, but I just lost you 45% of your life savings. Poof,
Mhm.
in 3 months." What a devastating phone call. I never wanted to make that call. I almost got out of the industry thinking this is just not my cup of tea. Thankfully, I never had to lose anybody's money. I was just helping prepare tax returns, but it was devastating to hear those phone calls. So anyway, stumbled across some strategies that would not go down when markets did. I got so interested in them that I set them up for myself, my friends and colleagues, and I buttressed all of it with starting my own business and said, all right, I really need to underline all this with a certified financial planner designation. That took me another 3.5 years. It's the longest, hardest studying I've probably ever done for anything in terms of my education. And I couldn't complain about it, man, because you get such a universe of information thrown at you. And I did not grow up learning money. I did not have a silver spoon in my hand, working poor family, that sort of thing. And so having this exposure to dynastic trusts and complicated the strategies that the wealthy have used for generations felt like it was a huge opportunity to then pass along that word to the masses. And now they call me not your average financial planner because I'm not typically going to throw you into a bunch of amateur retail investment products. like index funds or, God forbid, target date funds that most people have in their 401ks and IRAs.
Yeah, Mark, it's one of the reasons I wanted you on here, Mark. And you and I had a discussion offline about infinite banking and then bank on yourself, which is something that you do specifically. And the one thing that I really wanted to go into was because so CFPs get a really bad rap, and it's primarily because you have the ones that are like, oh yeah, I work for Vanguard, or I work for Chase, or I work for whoever, and I just take your money and I throw it in a fund and I call myself your CFP, and all I'm doing is pulling cash out of your hard-earned deposits and living. Um,
Yeah.
I have someone who my son said to me he was going to use as a CFP, and I said, "There's a reason that he drives, this Lamborghini, and all of his clients are driving Hondas.
Right.
Avoid that guy." You know what I
Yeah.
mean?
That's right.
So he did. But yeah, would you do me a favor and just let's go down that rabbit hole? What are you doing differently that separates you from everyone else?
There's a bunch of flat tires that come with traditional retirement plans. The vehicles of retirement plans come with their flat tires. The first is volatility in the markets. The average return of your stocks in your market portfolio might say 10% or whatever. But let me give you a quick math fun experience, a little math magic here. I can give you an average rate of return of 25%. How's that sound? Does that sound pretty good? 25%.
If I
Let's do the
wasn't
math
doing
here.
what I was doing, I would say, let's do it.
Okay.
Keep doing what I'm doing.
Let's say you had
Yeah,
10
sounds great.
grand to invest and you threw it into some stock
Mhm.
and it went up 100% this year. 100%. And then next year you now have 10,000 goes to 20,000.
Mhm.
Okay. 100% return. Negative 50% in year 2. So your 20% goes, or 20,000 bucks goes back down to your original
Yeah,
10,000 bucks. So you started with 10,000, you went up to 20, you're back down to 10. How much wealthier do you feel?
I feel broke,
Yeah. You still had the 10 grand you started with, right?
but it's
So
not the
you're
same because I had 20 and that's my new normal.
That's right. Well said. Yeah, your human psychology shows you feeling poorer. That's interesting. That's a good point. The reality is you got an average rate of return of 25% in that little math experiment. 100 minus 50 divided by 2 is 25%. That's our average return. The typical financial advisor is allowed by SEC to advertise that. Come on, what a ripoff. Your real return was 0%. And if you threw in human psychology and inflation, and not to mention who got the fees off of your back those
Yeah.
2 years, as you said, somebody was investing that and making money off of you. So I find that to be preposterous. And I don't see it as a reason. Your investment planner should not retire before you do off your money. And according to the Department of Labor, if you invest your money with just a 1% fee in your IRA over 35 years, which is typical for most people, keeping that IRA for retirement and whatever, you're going to lose 27% of your money just to fees. So that's almost one in every $3 gone to fees. Okay. Now that's if the market goes up, down, or sideways. And again, I feel like that's one of the big flat tires of most financial vehicles. Market volatility. Okay, that's one. Fees, that's another. Third is taxes. Most people think that, wow, hey, I'm getting this great deal. I'm deferring my taxes when I put money into my IRA or my solo 401k or my self directed IRA. You're a smart guy. Look into the future. Do you believe taxes are going to go down or up in this country? What do you think?
I've never seen in my life. I've never seen them go down. Listen, in all fairness, I've seen tax deductions go up, but I've
Yep.
never seen the standard rate of taxes go down. Never.
We've had, I think, $1 trillion deficits now for several years, and
Yeah.
that's now projected by the budget office to continue as far into the future as they can calculate.
Mhm.
I don't see that taxes are going to go down, and yet we are all deferring our taxes. Now, I can defer a root canal, but that may not be a good idea. All right. So that's the third flat tire. The final flat tire in our vehicle here is accessibility. We can't access that money and we can run out of it too.
Mhm.
So in retirement, we might be able to grab our 401k money out and spend it on a cruise ship or something. but we could run out. We could be 79 years old and working at Walmart. So those are the big problems I have with tradition. That's a long answer to your question, but it's a great one as far as what's wrong with traditional financial retirement accounts.
I fully agree. Yeah, I came to the realization, unfortunately, at 49 years old that I was going to work until I died. So I was going to get my retirement and retire. And then, yeah, I've got all this money that I can't touch. And now I've got to go get another job in order to make the difference between my earnings and my pension. So, yeah, not anymore. So
Where's it written
retired.
that we have to put our money in these things anyway? If the only place to buy your clothes was the mall, of course you're going to overpay, you're going to get undervalued, and you're ending up with a retail investment that ultimately someone else is taking off your back. What if you could go wholesale? What if you could go direct with your retirement? Those are the kinds of questions we try to find in our conversations with our clients.
Yeah. My favorite is, but they're matching.
Yeah. Hey, first of all, they call it free money, don't they? That
Yeah.
match, it's like free money, Mark. Okay. Yeah. If you really want to put in up to the match, no big
Yeah.
deal. The match is going to effectively take care of some of those fees and some of those taxes, but then you have basically just 3% of your salary or whatever they match going into a 401k that's going to underperform because it's tied to target date funds and more.
Mhm.
I don't mean to undervalue this, but there's no such thing as free money. The only free lunch is the cheese on the wrong end of a mousetrap. So please be aware that money that they're matching you is often vested for 7 years, locking you to your cubicle,
Yeah.
okay? And again, if taxes go up, that could more than eviscerate not just the match, but the money you're paying in there as well.
And that's a great point you just made. And it's a point that I've made to students and my own son. He loves his job. Great. Terrific. Because you're going to be there for a while as long as you're in their retirement program with your matching funds. If you really want to make your money work for you, take a loan against that money, invest with dad. I'll get you 25% outside of the fund that you get to keep. By the way, portion of that I can gift to him.
Yeah. Yeah, there
Um,
you go. Yeah.
right. So that's, yeah. But you don't want to be handcuffed. You definitely don't want to be handcuffed because they
Yep.
can control your salary.
And I don't want to push back on what you just said because I agree with what you're saying and you're giving him the chance to see outside of his 401k. But think about it this way with that 401k loan.
Hmm.
If that's a traditional 401k or pre-tax, think about what happens there. Let's say he borrows out $50,000 to invest with you or anybody,
Hmm.
or just whatever he wants to do with the money. That 401k is now in control.
Yeah.
And the provider will set up a monthly repayment plan, whether he wants to or not. And that money is going to come out of your son's paycheck.
Yep.
And that's going to be after tax money that he's paying back to the loan, right?
Mhm.
After tax money. Okay, now fast forward 30, 40 years or whatever, and now your son's retired. And now he's pulling that 50 grand out in retirement. Guess what's going to happen?
They're going
They're
to take
going
a
to
third of it.
tax
Yeah.
again, right? So that's two taxes. That's two taxable events on the same dollar. That is a very expensive way to borrow. Now, you
Yeah.
and I talked at the very beginning about how bank on yourself can work
Mhm.
and how you can become your own source of financing. I would highly encourage folks rather than borrowing from your 401k, which keeps the control in the hands of Fidelity or whoever, Vanguard or whoever owns
Right.
that thing. And then you get double taxed on your dollars when you borrow from your 401k. Yuck. That's like the highest interest rate loan I can
Yeah.
find. Rather, borrow from a dividend paying whole life policy that's properly structured. If it's designed properly, here's what happens, and I'll be very brief on this. Uh, First of all, when you borrow from the policy, if it's bank on yourself designed, and not all policies are, it will continue to earn interest and also the dividends will be paid even on the capital you borrowed. So if you've got 100 grand in your policy and you borrow out 70 grand to invest with Bud, the policy will continue to grow on the full $100,000 as if you had no loan taken against it.
Mhm.
Second, it's if we design it, it's tax free. Unlike a 401k, it's accessible without any taxes due. And third, the underlying asset, the life insurance, will grow guaranteed every single year, no matter what's going on in the real estate market or the stock market. To me, that beats the failures of traditional 401ks and IRAs and that sort of thing because of the reasons I mentioned. You get more control, better tax advantages, and you can leave a legacy at the same time.
I'm a fan. You're not. I've got no pushback on that one, Mark.
Hey, again, what you're teaching your son is to think outside the box. And
Yeah.
candidly, thinking is the most valuable asset he or any of us have. There's a quote that says, hey, 80% of people don't think,
Mhm.
right? Actually, the quote is 10% of people do think. Another 10 think that they think. And the rest of us, 80% would rather die than think. So
Yeah.
be among the few that are putting your brain to work. It's one of the most important investments you'll ever make.
I did not know what I did not know, uh, even with the masters, the 2 bachelors, the couple of associates, one's in contract. I I was the mayor of a small town. I didn't know anything about money and how it actually worked until I was done, and
Mm.
then read the Purple Bible, so to speak, and then I started doing my own research outside of the norms. Oh my goodness, there are so many different ways, and you touched on it a little earlier. You're teaching people how rich people think.
Yeah, most of the time, folks are building up, they think that building up a big pile of money in their 401k or IRA is the goal. And I want you to imagine, but have you ever done any like hiking, backpacking, mountain climbing, anything like that?
I was Yeah, yeah, a little bit.
A little bit, a lot of bit, maybe?
I bet.
Okay, cool. What's is it harder to go up the mountain, or is it harder maybe over time to come down the mountain?
Yeah, so it's a I know the adage, right? It's always harder going up unless you pick up momentum and you fall on your face coming. That's
That's right.
Other
Yeah.
than that, yeah, it's harder to climb.
It's yeah. And a lot of people think that, and my you're fighting against gravity and whatever. Apparently, the human body has difficulty going downhill over a long period of time.
Yeah,
And in fact, 85% of deaths are coming down Mount
yeah,
Everest, according to National Geographic. 85% of deaths coming down the mountain. So, strangely, this is also true with our money. Most of us pile up this big pile of money in our 401k or whatever. And now we're like, hey, we're 70 or 65 or 62. What the heck do we do with this pile of money? And what they end up doing is they have the go years,
mhm,
the slow go years, and then the no go years. Go years of the first 5 to 10 years of retirement when you're on the cruise ship and you're spending the money quick. Then you slow it down. You have some medical expenses. Those last no go years, though, can be the most expensive years of your life as you're in that nursing home or whatever, spending 12 grand a month or 15 grand a month in today's dollars. So, with all that in mind, the biggest risk we have is living too long.
mhm,
And again, 401ks have no answer for that problem.
yeah,
Now, real estate does. It produces a rent, whether you're 62 or 92 years old. Now, you might need someone else to manage that property for you. Have you heard the 5 T's of real estate? What is it? Taxes, termites, toilets, trash, and tenants. Have you heard that?
never I've honestly never heard that before.
Okay. So some of our clients, again, probably 45 to 55% of our clients are real estate investors, syndication managers. Some are doing flips, some are doing wholesaling, some are doing terms deals. There's a lot of people in our client base that are doing real estate to one degree or another, myself included. It's an incredible asset class that I highly recommend. And most CFPs could care less if you did
Yeah,
real estate because they can't find a way to get paid on it. All right.
yeah,
I don't care. In fact, I do analysis on your real estate deals. We talk about them. We incorporate them into your overall financial plan. I don't have a real estate license. So I'm happy to say, as a fiduciary, I don't get paid on that. And you get free expert advice on your real estate deals. That said, real estate has its limits, right?
yeah,
So sometimes what our clients do is they take some of the, and I'll tell you a quick story. Had a lady, she had 10 properties. She was in her 70s and she was getting a little bit tired of chasing after people for rent. So what she's been doing over the last 2 or 3 years is she's systematically selling a few of her properties. She's going to keep 3 or 4 of them,
mhm,
the tax deductions and whatever, but she's moving the equity from her properties into something called a fixed index annuity.
yeah,
And that annuity is producing more rent money. It's a stream of income than the rentals were. And she doesn't have to worry about those 5 T's of real estate. Now I get it. Dave Ramsey told me not to like annuities.
right,
Okay? And I'm supposed to believe everything he says. And I agree that a lot of times annuities can be a bad deal. You want to really read your paperwork before you sign one. However, Annuities have no assets under management fee. There's no property taxes to be paid on annuities. They just give you a check for life. As long as you live or your spouse lives, you'll get an uninterrupted, guaranteed lifetime income. And if we do it right with some of the companies I like to work with, they'll even raise your income over time following an index or whatever. And I had this lady I mentioned, her income's starting at like 70 grand a year, but it's going to be increasing to 90, 100, 150 grand as the years go on. That's supplementing what she's getting from her rent and, of course, Social Security. So it can be annuities. I know, strange to say, but they can be an incredible tool to maximize your income.
That's a fantastic point. What as far as so let's go down that rabbit hole a little bit more because it's not just annuities, it's coupled with a few other things. What would you partner that with in order to help them with the generational wealth beyond
Yeah.
just the, hey, we're putting all this money in here, we're going to get our guaranteed income,
Yep.
what's left over?
Yeah, you want to spread your assets not just among 12 baskets, like diversifying into a couple different baskets.
Mm.
You want to put some of your money on multiple trucks in case those 12 baskets on one truck goes off a cliff.
Right.
So diversifying among asset classes. This is why you shouldn't do all real estate. You shouldn't do all annuities. You shouldn't do all CDs or muni bonds or whatever else is on the table here. Stocks too, right? So it's asset allocation. And we're back to that conversation. It's the fancy $20 cocktail term. But what if you had a couple of real estate properties to provide passive income, incredible tax advantages,
Mhm.
and of course, all the advantages of real estate? You had a couple of annuities to produce a efficient stream of income. I cannot find anything more efficient, not dividend paying stocks, not real estate, not muni bonds, not anything that I can find that produces more efficient income per dollar invested than an annuity can. Then throw in a couple of whole life, bank on yourself approved and designed whole life policies. That's your liquid money that you can be borrowing for real estate repairs. And I talked to a guy earlier today. He's got 18 properties down in San Antonio. He just bought them 6 months ago, and he's had to call three different HVAC companies to do repairs. What if he had a policy where he could borrow from those cash values
Mhm.
to make those repairs and
Yeah.
even make his next down payment on his next couple of deals? Great opportunity there. So have some whole life policies. And then, of course, play with the rest. Anything that you want that you see, dividend paying stocks are going to be very stable over the long term, but they're affected by market volatility, the world economy, and more. I really believe in the power of contracts, and I'll hush after this, I promise. The contract is the bedrock of civilization. Contracts are where we get value from our real estate. Without a contract, all I have is squatters' rights in my properties. Without a contract, all I have is who's got the bigger shotgun. That's who owns that property, right?
Right.
So I need a contract for wealth, for real wealth. And that's where insurance is. Insurance is a contract. Whole life insurance is a contract. Annuities are a contract. Real estate rental properties are a contract. So deal with contracts and maybe leave the rest to paper wealth advisors. Paper wealth advisors would be your Fidelities and your TD Ameritrade, not to name names,
Yeah.
people who are into the stocks and the bonds and the index funds. And that's all paper gains and paper losses.
Yeah.
And as we've talked in the beginning, there's a lot of flat tires on that vehicle. Is it wrong to get into the stock market, real estate? No, of course. Do all. With money you can afford to lose, put it wherever you want. I don't care. It's your money. I'll be there as a CFP to give you advice and feedback. But ultimately, we want to make sure we're building real wealth that you can count on.
Yeah. Now, are you leveraging IRAs, self-directed or not, or Roths or self-directed or not, 401ks and whatnot in the total?
My favorite tool for real estate is outside of the IRA. And here's why. I get it. I know it's popular to do self directed IRAs. Real estate inside of my IRA is cool because I usually have my biggest asset is my 401k or my IRA. So it's like Willie Sutton, right? The guy who kept robbing banks. He robbed 18 banks and he finally got caught. And the police are like, "Hey, why do you keep robbing banks?" And Willie Sutton says, "Because that's where the money is."
Yeah.
Genius guy, right? Anyway, IRAs, 401ks, that's where the money is. By the way, the government knows that's where the money is too, so be
Yeah.
careful. But just because you have a big IRA does not mean real estate is necessarily the place to use the money for your for your real estate. Here's what I mean. When you have a self-directed IRA and you buy real estate within that IRA, you're losing all of the major tax advantages that come with real estate. You cannot do cost segregation. You cannot do bonus depreciation. You cannot deduct the interest on your mortgage. It's harder, sometimes harder to get loans, although not with commercial properties usually. And there's just typically a lot of red tape that comes with self-directed IRAs. On the other hand, if you own your real estate outside of your IRA, you can take advantage of all those tax advantages. And you can use your policy, your bank on yourself policy, to make the purchase and get two assets for the price of one. So, am I saying never do self directed? No. We have a lot of clients that love their self directed, have their real estate in there, but just go in with eyes wide open of what you're getting and what you're losing when you use IRA money for real estate. That's all.
Nice. So I'm just going to ask you before we go into the soaring four, what is one thing that you learned as your wealth increased?
Oh, yeah. Good question. When you have money, it can solve a lot of problems, but it creates new problems. And a mentor recently said, Mark, in life, you get to choose your regrets. And I really like that idea that it's not fun to have regrets, but you can choose those regrets. You choose your problems. So, do you want small problems or big problems? As your wealth grows, you're going to be given the choice to stick with your small known problems or go to bigger, scarier problems. And I don't know, bud, the successful seem to chase after the bigger, scarier
Big
problems.
ones. Yeah. Hey, I don't know how to do marketing, or let's go find somebody who is. Or what's my problem now?
Yeah,
On
that's
and now I
exactly
have
right.
income and I don't know what to do with it.
Yeah,
It's not a bad problem to have,
you
but
bet,
it's
man.
still a problem.
Love it.
All right, Mark, we're going to go into the soaring four. These are the same four questions that I ask every guest who can help someone who is just starting out achieve new heights.
Sweet.
What do you use to keep you motivated?
Every morning I use a simple journal that gets me on my thought train, picking out my top 3 goals that I need to take care of or tasks I need to take care of today. It gets me focused and centered on my life goals and more. It reads me a little quote at the top of each page. So keeps me motivated because it makes sure that every single day is a gift. And I want to make sure to squeeze all the life out of it that I possibly can.
Awesome. I love journaling. Uh, what is one thing you learned that completely changed your mindset?
This idea that banking is a verb, not a
Mm.
noun reserved for others, is a game changer for me on the financial realm. When I realized you could insource your banking, when you could sit on the other side of the banker's desk and become your own banker, that changed everything for me. It helped me pay off my student loans, helped me invest in real estate, and lots more. So I would say the mindset and the skill set of being your own banker.
Excellent. What tools do you use to keep yourself on track?
Man, that I guess I shot myself in the foot. That journal that I mentioned, it's the Full Focus Journal. Michael Hyatt puts it out. Great book, and I've made a digital version of it, but it keeps me on track. It makes sure hey, what's the very next step you need to do to get you toward your quarterly goals? And so we follow the EOS model,
Mm. Yeah.
which I think who is it? Gino Wickman.
Gino
Um,
Wickman. Yeah.
yep, great. I think that's it. Yeah, we've used that for several years. Follow that model and agenda as well.
Great. Great books. Traction and
Yeah,
Get a
traction.
Grip.
Mhm.
And yeah, they're fantastic series. And then the last question is, if you were to lose everything today and had to start all over again, what would you change?
I think if I was starting over with 0 in the pocket,
Mhm.
time management and time blocking would probably be my first skill that I would master. If I had no skills, nothing, time management and time blocking. So I'm going to set aside 3 hours today to learn how to make the best lemonade on the block so I can sell it at the lemonade stand. That would be what I would do if I had to start fresh, is just get my skills through time blocking and time management.
So what's going on for you guys next? You're growing, obviously you're successful. Where do you go from
Yeah, the best thing I can say is we've had the great privilege of working with over 1,000 clients across the country, all 50 states. and we are still open for business. We'd love to serve and be a part of a revolution that brings this strategy, this not so average approach to finance to at least 10% of America. I want to do my part, man. No more, no less. I want to do my part to see this world better off than when I found it, as little bit as I can do, my finite self. We have several colleagues and advisors. We're hiring a few more. So if you'd like to participate in that in any way, I just say, hey, go to kickstartwithmark.com, kickstartwithmark.com. And we usually do like a 15-minute phone strategy session. It helps us get to know you and answer your questions and see if we'd be a good fit. So it's a chance to ask questions on what you heard today, or see if there's some opportunity for you to put together some of this contractual wealth that we've been talking about today. So that's kickstartwithmark.com.
Terrific. And Mark, I'm going to have all of your social media in the show notes as well. I really do appreciate your time. I know you're very busy.
And thanks. And for those that are listening, if you type in aim high into the form on that Kickstart with Mark, I have a book that hit the #1 bestseller list on Amazon and on real estate investing. It's called How to Fire Your Real Estate Banker. It's the name of the book, How to Fire Your Real Estate Banker. And I'd be happy to send that to you guys free of charge.
Outstanding. Thank you very much for that. I appreciate it.
Thanks, Ben.
All right. Mark, again, thank you very much for your time. And I will look forward to talking to you real soon. Thanks for watching. We hope you enjoyed it and learned something new today. If you did, please show us some love and smash that like button. Your support means everything to us and helps us reach more people like you who want to aim high in real estate. Don't forget to hit that subscribe button along with the notification bell icon so that you can stay up to date on all of our future content. If you're hungry for more real estate and finance related videos, we've got you covered. Check out this video by clicking on the screen. Thanks for being a part of the Aim High community. Your support drives us to create valuable content, and we can't wait to see your success stories in real estate investing. Till next time, aim high, never stop learning. Bud Evans, signing off. We'll see you soon.